Hello everyone, my name is Dhruv Sani. So today we are going to cover the concept of working capital cycle in the course of financial management. Definition, we'll start with the definition. What does working capital cycle mean? The working capital cycle is the amount of time it takes to turn the net current assets and current liabilities into cash. The longer the cycle is, the longer a business is tying up capital in its working capital without earning a return on it, right? So before getting into the understanding of working capital cycle, we need to understand the operating cycle first. So how our operating cycle starts? So when you start a business, you purchase raw material initially, and you do work on that, and that is work in progress, and you convert them to finished goods, right? So that finished goods are used for sale, right? You sell those goods for earning profit or earning money, or yes, and that sales leads to account receivables like creation of debtors. Like if you provide goods on like you can say on like if the payments are receivable on a later stage, that is accounts receivable. Or you can directly jump from sales to cash in hand if the customer is buying the products or services from you in cash, right? And that cash in hand is used for purchase of raw materials again. This creates the cycle, basically the operating cycle. So we have an operating cycle formula here. Operating cycle is equal to raw material and short stage plus work in progress stage plus finished goods stage plus debtors collection stage minus creditors payment period stage, right? So this is like raw material and short stage is can be calculated by R is equal to average stock of raw material divided by average raw material consumption per day. W can be calculated by average work in progress inventory divided by average cost of production per day. D can be calculated by average book debts divided by average credit sales per day. F here can be calculated by average finished stock inventory divided by average cost of goods sold per day. C can be calculated by average trade creditors divided by average purchase on credit per day. So that was all about operating cycle. So now we'll start with the working capital cycle. Now working capital cycle, as you can see, like cash, then we do purchases, purchase of raw material and inventory, then we do production, then we convert them to finished goods, and the customer invoice, as earlier told, like accounts receivable, and then collection, and then cash. This is similar to like the operating cycle. Working capital cycle calculation. The working capital cycle can be calculated like inventory turnover in days plus debtors turnover in days minus creditors turnover. Basically, turnover here means turnover in cash and cash equivalents. Thank you.